John has $1 million. He wants to buy a $1 million house and pay for it in cash, but there's a problem. If he buys the house today, his account goes to zero. John doesn't want that. Nobody wants that. So he starts asking a different question. Instead of asking, can he buy the house, he asks, how fast can he double this $1 million using ETFs? Because if he can turn it into $2 million, he gets to keep the house and still keeps $1 million in his account. So now the entire problem comes down to one thing. How fast can that actually happen? In this video, we're breaking that question down step by step. We'll look at how different ETFs grow money at different speeds, starting with the most familiar conservative option and moving toward the fastest, most aggressive one. For each ETF, we'll walk through what it holds, how it grows, and how the projected value of John's $1 million changes year by year until the moment a second million finally shows up. And in the end, I'll show you which ETFs take that timeline from about 6 years down to as little as 2 years so John can buy the $1 million house in cash and still have $1 million left in his account. To see how that timeline gets compressed, John starts with the most familiar option first, the one many investors already use as their baseline, which brings him to the Vanguard S&P 500 ETF, ticker VOO. This fund tracks the 500 largest publicly traded companies in the United States. It's weighted by market value, which means the companies that perform the best naturally become a bigger part of the fund over time. There's no manager making bets and no attempt to time the market. It simply owns the dominant businesses that already drive the U.S. economy. VOO is built for reliability. It's broadly diversified across sectors. It carries an extremely low expense ratio of 0.03%, and most of its long-term returns have come from steady price appreciation rather than income. Dividends exist, but they're not the main driver. Looking at the last 10 years, the chart shows VOO is up roughly 269% in total. Spread across that decade, that averages out to about 12.61% per year. That historical growth rate is what sets expectations before projecting anything forward. Based on that pace, John starts running the numbers on what VOO could realistically do for him. If he places his $1 million into the fund, projections show the portfolio valued at around $1,137,200 after year one. In year two, as compounding continues to stack, the projected balance moves up to roughly $1,292,395. By year three, John's looking at a projected value near $1,467,888, and by year four, around $1,666,277. As John keeps pushing the timeline forward, the compounding becomes harder to ignore. By year 5, projections place the portfolio at approximately $1,890,488. Then, in year 6, the moment he's been waiting for finally shows up. The account is projected to be valued at about $2,143,818. At that point, the second million is hit. John can buy the $1 million house in cash, and his original $1 million remains invested. For John, that 6-year wait becomes the trade-off. VOO offers stability, broad exposure, and patience, but not speed. So once he sees how long it takes, even when owning the biggest companies in the market, the next question becomes unavoidable. If this is the timeline when he sticks with market leaders, what happens when growth itself becomes the priority instead? That question is what leads John to the next option on his list, the Vanguard Growth Index Fund ETF, ticker VUG. This fund is built by filtering the U.S. market down to companies expected to grow faster than average. Instead of trying to own everything, it leans into businesses that are reinvesting heavily, expanding revenues, and pushing earnings growth harder than the broader market. VUG still holds hundreds of companies, but the mix looks very different compared to VOO. Slower-growing sectors get less weight, while technology, communication, and growth-oriented businesses take the lead. Looking at the last 10 years, the chart shows VUG is up roughly 402% in total. Spread across that decade, that averages out to about 15.31% per year. That higher growth rate is the trade John is making before looking at the projections. Based on that pace, John starts mapping out what VUG could realistically do for him. Projections show that by year one, the portfolio would be valued at around $1,157,300. In year two, continued growth pushes the projected balance to roughly $1,338,782. By year three, John is looking at a projected value near $1,548,150, and by year four, around $1,789,673. The difference shows up quickly. By year five, projections place the portfolio at approximately $2,068,274. At that point, the second million milestone is hit, and John can buy the $1 million house in cash, and his original $1 million remains invested. That 1 year difference comes from prioritizing growth over balance. VUG proves that simply leaning into faster-growing companies can pull the timeline forward without changing anything else. But John isn't done asking questions. If growth alone can shave off a full year, he wants to know what happens when growth stops being broad and starts becoming focused. That question pushes him towards the Vanguard Information Technology Index Fund ETF, ticker VGT. VGT narrows its focus almost entirely to technology and innovation-driven companies. Software platforms, semiconductor designers, hardware manufacturers, and digital infrastructure providers make up the core of the portfolio. These are businesses that can scale quickly, expand margins, and grow earnings without costs rising at the same pace. Unlike the previous ETFs, VGT is not trying to represent the whole economy. It's deliberately leaning into one sector that has reshaped how people work, communicate, and spend money. Nearly all of the return comes from price appreciation. The expense ratio stays relatively low, but the trade-off is concentration. When technology leads the market, this fund moves fast. When it struggles, the swings are much larger. Looking at the last 10 years, the chart shows VGT is up roughly 676% in total. Spread across that decade, that averages out to about 22.03% per year. That kind of growth is what pulls the timeline forward so aggressively. Using that growth rate, John runs the numbers on what this could look like over time. Year one puts the portfolio at a projected value of around $1,224,400. By year two, compounding lifts the balance to roughly $1,498,138. By year three, the projection shows the account nearing $1,832,082. Then the timeline finally breaks open. By year four, projections place the portfolio at approximately $2,239,497. So at year four, John can buy the $1 million house in cash, and his original $1 million remains invested. Cutting the wait down to 4 years comes from committing fully to a sector built for scalability. That decision answers one question for John, but it immediately creates another. If focusing on technology can move the timeline this much, what happens when he stops spreading across the entire sector and narrows in on the part that actually powers it? We'll see that next. And in the end, I'll show you an ETF that takes that timeline from about 4 years down to as little as 2 years, so John can buy the $1 million house in cash and still have $1 million left in his account. But first, let's look at a specific part of the sector. The iShares Semiconductor ETF, ticker SOXX. Here, the focus tightens again. Instead of owning all of technology, SOXX concentrates on a single layer underneath it: semiconductors. These are the companies designing and manufacturing the chips that run data centers, smartphones, artificial intelligence systems, and nearly every modern device. Without them, none of the software, platforms, or digital services would exist. SOXX is built around a much smaller group of companies compared to the previous ETFs. That concentration is intentional. When demand for computing power rises, chipmakers often see explosive revenue growth, but the reverse is also true. This industry is highly cyclical, which means periods of rapid expansion can be followed by sharp slowdowns. Dividends play almost no role here. Returns are driven nearly entirely by price movement. Looking at the last 10 years, the chart shows SOXX is up roughly 1,208% in total. Spread that across the decade, that averages out to about 28.69% per year. Based on that pace, projections show that if John invests his $1 million into SOXX, the acceleration is immediate. By year one, the portfolio is projected to be valued at around $1,291,888. In year two, continued compounding pushes the projected balance to roughly $1,668,165. Then the shift becomes undeniable. By year three, projections place the portfolio at approximately $2,153,124, placing the house buying target within reach in just 3 years. Getting there in roughly 3 years comes from extreme concentration in a single fast-moving industry. And for John, that raises one final question. If concentration alone can compress the timeline this much, what happens when leverage is added on top of growth? That's what leads John to the final option, the ProShares UltraPro QQQ ETF, ticker TQQQ. This fund removes the last layer of restraint. TQQQ doesn't simply track growth companies, it uses leverage to magnify the daily movement of the NASDAQ 100. This ETF is designed to move about 3 times as much as the NASDAQ 100 on a daily basis. TQQQ holds the same underlying companies you'd find in a growth-heavy NASDAQ portfolio, but it adds leverage on top. That leverage is reset daily, which makes this ETF behave very differently from everything else John has looked at so far. Gains can stack quickly during strong trends, but the margin for error becomes much smaller. The expense ratio is higher at 0.82%, and volatility is no longer a side effect, it is the defining feature. Looking at the last 10 years, the chart shows TQQQ is up roughly 3,360% in total. Spread across that decade, that averages out to about 41.13% per year. That kind of growth explains why this ETF sits at the extreme end of the speed spectrum. With TQQQ, John doesn't need to wait for compounding to slowly reveal itself. The projections move fast enough that the timeline almost collapses. Within the first year, the portfolio is projected to clear roughly $1,417,600. And before a second full year has even passed, the balance is projected to cross the $2 million mark at around $2,005,916, making it faster than any other fund on the list. That crossing is all that matters. John can buy the $1 million house outright even before the end of the second year while still keeping his original $1 million. When you line the timelines up from longest to shortest, the pattern becomes very clear. The slowest path belongs to VOO, the Vanguard S&P 500 ETF. By prioritizing broad exposure and stability, it doesn't reach the $2 million mark until year 6. Next is VUG, the Vanguard Growth Index Fund ETF. By leaning into faster-growing companies while staying diversified, it shortens the wait and reaches the target in year 5. After that comes VGT, the Vanguard Information Technology Index Fund ETF. By concentrating entirely on the technology sector, it pulls the timeline forward again and crosses the $2 million mark in year 4. Then there's SOXX, the iShares Semiconductor ETF. With extreme concentration in a single fast-moving industry, it compresses the timeline even further and reaches the goal in just year 3. And at the near end of the chart is TQQQ, the ProShares UltraPro QQQ ETF. By stacking leverage on top of growth, it cuts the timeline down to its shortest point, hitting $2 million in roughly 2 years, faster than any other option on the list. Want to know how I would build a portfolio in 2026 if I had to start in 2026? Click the video on the screen to find out.